was once told, if somebody told you they understood how milk is priced, then they're a liar. Well, at the risk of being a liar, I'm going to try to pull together a short program that explains how milk is priced. Now, weekly I do a podcast on the website called thecwtgroup.com, where I try to overview some of the different things going on in the industry and what is actually impacting milk prices. In this particular video, what I want to do is show you how to calculate this portion of your milk check, which is the majority of the check, which is the components, producer price differential, and the location adjustment. So this is definitely a circular system, and I'm never quite sure where to start on explaining this. So I think what I'm going to do is start around the 15th of the month, which is when you get your check. And what we're going to do is focus on the report that comes out from USDA on the statistical uniform prices. Now, for this particular example, I'm going to use order 33. So this is real data for October 2021. And so the first thing that they report is how much total money was collected in the pool. And so this is the pool dollars for order 33. And that came out to be $19.44 a hundredweight. So basically what that is if you add up everything that went on in the pool, what went out as class 1, what went out as class 2, what went out as butterfat, what went out as everything else, and then you put that all together, there's $19.44 that are in that pool. Now, the next thing that they do is they pay out all the components, and all the components are paid out on class 3 values. And so that is something that is kind of the root of everything that's in the milk check, and that is based on history. But the bottom line is we know that the components of the pool are 393 fat, 322 protein, 576 other solids. And the important number is, what is the value of those components above standard 35, 299, and 569? So these are the standard numbers in class 3. And the question is, if you have this amount of components, how much more value do you have? And that's pretty simple to calculate. So it's $1.74. We collected $19.44. So that means that the statistical uniform price is the amount collected minus the components that are paid out, which gives us $17.70 left. Now that seems, again, a bit convoluted, but we know how much we collected. We know how many excess components we have. So now we need to figure out how much is left. And in my opinion, this 1770 is the number that everybody should be focusing on. But unfortunately, they don't. They want to bring this back to class 3 and say class 3 price was $17.83. We'll show you how that was calculated in a little while. Since this is higher than this, we have to adjust because the pool never makes or loses money. So that says there's a 13-cent adjustment that has to be made to bring that back into balance. So again, let's go through this a little bit slowly. We collected $19.44. We paid out an extra $1.74 components because we had more than 35, 299, 569. That left us $17.70 left. Now that's less than class 3. So the difference here is 13 cents, and that's what is called the producer price differential. And everybody gets nervous when this is negative, and all that is saying is that the total amount collected was less than class 3. Now nobody anointed class 3 as being the god of milk pricing, but unfortunately in this system that's exactly what it's done. Is everything comes back to class 3, and then we need to know how different we were. And so in this case, there's 13 cents that have to be taken away to match up to that statistical uniform price. I know that's a bit complicated, but it's just like balancing a checkbook. So again, let's go through this again very slowly. The statistical uniform price is $17.70. Class 3 is $17.83. We need 13 cents to bring those two together. And so we have a negative 13 cent PPD in this particular example. Now the important part of this is the PPD at, in particular, Order 33, Cuyahoga County in Ohio. Now why there, I can't answer that question right now. And so the issue is everything is adjusted from that. So if we are in Lansing, Michigan, for example, that is what's called a $1.80 zone, and Cuyahoga, Ohio is a $2 zone. So what that means is now we have a 20-cent location adjustment. And this is in the Federal Registry. You can go find out exactly which county you're in and what the location adjustment should be. And so wherever it is set at, in this case, Cuyahoga County, you figure out the zone that is, and then you figure out the zone that you're in, and the difference between the two is the location adjustment. So one of the things that as soon as you start calculating these things, you find out that if we have more components in the pool, for example, we increase fat to 4% instead of 393, that is going to lower the PPD. And again, if you think about it, what happens is we pay out the components to get the statistical uniform price. So if we pay out more components, then that's going to make less for the PPD. And so, for example, let's assume that the components above this standard are now $2 instead of that $1.74. And what that would do is we have the same amount collected. We have $2 that is extra components, so that gives us a statistical uniform price of $17.44. The difference between these two now is 39 cents. So we're going to have a negative 39 cent PPD, and it was only because we had higher components. But in this case, we had exactly the same amount of money that was collected in the pool. So having that negative PPD didn't mean that we had, less money in our pocket. It's just that it was paid out more into components than in the statistical uniform price. Now the problem is we're going to have depooling. So if you think about it, for example, if class 3 is particularly high and we take that money and we put it not in the pool, that's going to lower the amount of money collected by the pool. And again, this is Order 33. This is the class 3 utilization. And so there are significant periods when, to me, it looks like the pool is depooling, because normally they're around 36, 37, 38% class 3. And look, for example, down here in June of 2020, they were only 5.9. That means that all that milk was being taken out of the pool and put somewhere else. And so I'm going to just run a quick example here. Is if we have the same amount of money, the same amount of prices, but instead of having 36% class 3, we only have 20% class 3 because you depooled it. Now all of a sudden the money in the pool goes from $19.24 to $18.79. Again, milk prices all stayed the same, and it's just because we've taken that higher price milk out and paid it directly. So in this particular case, depooling cost the PPD 45 cents. So again, when you see a negative PPD or PPDs are lower than you want, the first two questions I ask is, was the order depooling? and were the components higher than we would have normally expected to be? Because both of those can add, you know, like close to $1 in lower PPD. So now let's try to get these first three lines, which is the actual components. And again, if you have those butter, fat, protein, and other solids at 3.5, 2.99, and 5.69, that is going to be class 3. So another way of looking at this check is we have class 3 here. We add the PPD, we take away the location adjustment, and then we have what's called the statistical uniform price. All right, so getting to the components is a 4 or 5 week process. And so what happens is they release these components on the Wednesday following the last Saturday of the month. And the way that they achieve these components is each week they conduct a survey of all the commodity prices for the previous week. So the reports are closed at midnight on Saturday night, and they have to get the reports to USDA by the following Tuesday. And these come out at 3 o'clock on Wednesday. And this is called the National Dairy Product Sales Report. And it looks, you know, something like this. And so this is the report for butter. This is the last week. Butter was at $1.95.99. And there was 1,784,905 pounds sold. And they're going to do this for butter, block cheese, barrel cheese, whey, and non-fat dry milk. And then what happens is these get weighted together, and there's either 4 or 5, depending upon how many Saturdays in the month there are. And then they report back out. This is the price of cheese, this is the price of butter, this is the price of non-fat dry milk, and this is the price of whey. And so that is what is reported, you know, in the component prices. Now the next part is pure mathematics. If we know those, we can actually begin to calculate, you know, what is the other solids price, what is the butter price, what is the protein price. There are mathematics to this. If you're really interested in what all this means, that'll be in Milk Price 102, because right now all you need to know is that they are very established formulas, and it says if you have these prices, this is the class 3 that you're going to get. And again, it's mathematics, and it's not something that we need to worry ourselves about. It's just that it is very well known. It's not any kind of guesstimate. So if we review your milk check, we have a county location for price differential. So again, in order 33, it's released at a $2 zone. You know, Lansing, Michigan is a $1.80 zone. So that's a minus 20 cents on the milk check. The dollars collected into the pool are dictated by the utilization of class 1, 2, 3, and 4. And again, if you're going to depool, then there's going to be less of class 3. And that's why that utilization is terribly important. We need to know the components of the pool, because if we have higher components, then we're going to take more money out as components and less money out as fluid, if you might think of it that way. And then we simply need to know the commodity prices that were reported the 4 or 5 weeks prior to that being announced. And then we can actually estimate the milk check fairly easily. So let's talk about price discovery for just a minute, because the first part of that is just purely mathematics as to how your milk check is calculated. Now, price discovery has really nothing to do with actual calculation of the milk check. So this is the December class 3 futures on the CME. I don't know how often people say that prices dropped, 50 cents or $1. Well, this is nothing more than a speculation. The traders are trying to speculate as to how USDA is going to announce those prices. This 1950 has got absolutely nothing to do with the final announcement of the Class 3 price. Now, that doesn't mean you can't go and protect that price up there, but that's a whole different subject. Another piece of price discovery is what is called the spot market. The spot market happens basically every day, and it is an actual auction. The important thing of the spot market is that is physical delivery of product. If you buy a load of cheese on the spot market, you can expect it to show up this next week, because this is physical delivery of product. Oftentimes, this is referred to the market of last resort. I need a load of cheese, or I have to get rid of a load of cheese, and I don't have a buyer, so I'm going to go put it on the spot market. 11:45 is whey, 12 o'clock is cheese, 12:15 is butter, and at 12:30 is non-fat dry milk. To try to give you an overview of the spot market, I'm going to let the play here for last Friday. And it starts with a mandatory 1-minute trading, and then it's going to go into a series of calls. And if the price is not either increased with a bid or decreased with an offer, it will close on a hard call. But on this particular one, you'll see there was a pretty active trading schedule. And so I'm going to speed this up so that it doesn't take us 10 minutes to go through this. So at this point, we had a $1.45.5 bid on barrels and a $1.73 offer on blocks, and that got hit into a trade. Now the 1-minute trading is over, and it goes into a call situation for 30 seconds. And if it's not improved the price either by a bid or decreased by an offer, it will close on a hard call. Now we'll have 8 minutes of trading, and in that trading we will have 4 trades of barrels and 2 trades of blocks, and then we'll go into what's called a final call, and then if there is still activity, they'll go into an extended call, and then at the hard close at 10 minutes. This final call is fairly active. We'll actually have 5 more loads of barrels sold and 1 more load of blocks sold. And so when we're done, we'll see what the final prices were, and that will kind of get translated into how prices get sold this next week. Now that we've gone through all that chaos, this is what it kind of looks like mathematically. That first load of blocks was sold at $1.73, the second load $1.83, and the third load $1.85. So there was a significant rise, and that was actually a 12 3/4 cent rise for the day. These barrels started out at $1.45, went up to $1.55, kind of in between, and for the day it was a 6.5 cent increase. The other thing that we look for on these is what kind of offers are left. That gives you a sense of what's going to happen tomorrow. And so there was $1.51, $1.52, so that's kind of below the last sale. Or what kind of offers exist, in this case $1.53, $1.60. But what it gets reported at the end of this is blocks were $1.85 3/4, and barrels were $1.52, even though there was all that chaos in between. So why is this important? What it took me a while to figure out is there appears to be a 2-week lag between the spot market and the National Dairy Sales Report. And you might say, well, why is that the case? And it took me a while to figure that out. But if you think about it, if you're sitting in a chair trying to sell cheese to a supermarket or something, they're going to call you up and say, what's the price of cheese? And you quote them last week's spot market. And when do you want it? Well, it gets delivered next week. And so that kind of builds in that inherent 2-week delay on the spot market versus the National Dairy Sales Report. And if you look at them, they correlate fairly well. And where they don't correlate, if there's some differences, in some of these peaks and valleys, that's simply because the spot market is not 100% representative of all cheese that gets sold. but about 80% of the cheese in the US gets sold according to the spot market price. Perhaps the big question is, why should you spend time trying to understand your milk check? I mean, other than it's the main core of your business, understanding the things that impact your milk check is going to give you opportunity to see things probably a little bit faster and to take advantage of things that you otherwise may miss. And so if you want more information on milk pricing and kind of things that are impacting your milk check, check out the weekly podcast that I do on the CWT group, or let me know if there's anything I can do to help you.